Hey, everybody. Welcome. We are on the record, as we say. I'm Tom Schmidt from Ticker Tape Investments, and we're here tonight to talk about TTI Merchant Holdings, LLC, a new offering from Ticker Tape Investments. I've got Pete Renato on with us, who's he's one of the principals of the group we're investing into. So he's going to present the details of the opportunity. But kind of before I get into that, I'll go through some of the background on ticker tape and so forth. Thanks everybody for joining us. And with that, I will take it away. First of all, standard disclaimer, this is not an offer to sell securities. You must be an accredited investor in order to participate in these deals. And we're not offering to sell securities tonight. We're just literally telling you about an investment that Rita and I are making and inviting others to review the opportunity, review the private placement memorandum, and decide whether to invest alongside us. A lot of people ask me, what's ticker tape? Why are you doing this? How are you doing this? What's going on here? So I like to run through this real quick. Ticker tape is a loose affiliation of individual investors and small institutions that pool their expertise, their money, their time, and even their deal flow to build a diversified portfolio outside of the stock markets. We invest in or have invested in everything from the South Beach, Miami hotel that's at the top of the screen there to multifamily deals, multiple hotels, restaurants, litigation funding deals, and of course, lots of pre-IPO deals that you've probably heard us talk about. All the logos on the screen there are companies we bought shares of in anticipation of an IPO. We've had a bunch of exits in those among Palantir, SoFi, Outbrain. We have USA Rare Earth literally going public as we speak. Supposedly it's going to begin trading next week, and we'll have a restriction on our shares for something between 0 days and 6 months. So we're waiting to see what happens there. Looking to get a very nice return on our investment in that one. Also, we have the 3M litigation, which is settled. That's a litigation funding deal. Again, trying to get diversification in our portfolio. We've received our first distribution from that settlement, looking for at least 2 more coming to us to return money. Also, on pins and needles, hoping that both Ripple and Kraken file for public offerings this year as expected now that we have a new chairman of the SEC. A little bit about us, and I won't spend a lot of time on this. I'm Tom Schmidt. I'm a 28-year attorney who's been representing investors in everything from litigation to financial transactions. I am an active entrepreneur. Utility Rescue, one of the ticker tape deals, is the 17th company that I've either founded or co-founded. I'm a graduate of the University of Pennsylvania and the University of Texas Law School. Rita Carpel, my partner in ticker tape, has been doing business development and investor relations for over 30 years. She's raised over $300 million and started out on the floor of the Chicago Merc Exchange as a very young lady, going elbow to elbow with all the crazy traders on the floor. Open deals at ticker tape. Of course, we have Utility Rescue. If you haven't heard already, you should know that we are raising the share price from $2 to $2.50 1 week from tomorrow. So if you're considering that one, the clock's ticking. You can get in at a $2 conversion price instead of $2.50. TTI Merchant Holdings is our newest offering. We're literally announcing it right now. We have TTI Fourth Multifamily, a metaverse fund, a vacation rental deal on a group of houses in the St. Louis area. That deal is going to be announced and launched on March the 19th, so in a couple weeks. Very excited about that one. And last, but certainly not least, I got some good news yesterday. We already have raised, I think, $3 million plus for SpaceX, but we did find from one of the partners that's reputable that we've invested with in the past, had $200,000 worth of SpaceX pop up. So we're looking for investors to take a piece of that as well. With that, I'm going to turn it over to Pete Renato, a attorney in New York City who is also a active capital advisor. He is one of the principals in the group that Ticker Tape will be investing into, kind of overseeing the deployment of our capital as well as other people's capital in merchant cash advance deals. And so, welcome, Pete. Are you there? And can we hear you?
Yeah, can you hear me?
I can. Actually, I did forget to mention, I told Pete I was going to do this, then I forgot. You guys should all know the drill by now. There is a little function in GoToWebinar called questions. You can click on that as Pete's going through this. If you have any questions about the opportunity, just type them in there, and then at the end, we'll look at them and address them as needed. With that, take it away, Pete.
Very good. Yeah, thank you, Tom. So, yeah, I'm an attorney in New York, 25 years of experience. I've also been an entrepreneur. I work a lot with venture capital, small business, growing businesses, and like your group, I also like to look at pre-IPO projects. I'm a private counsel for a Russian family office who owns several buildings in New York City. Also active investors. So I'm involved a lot in reviewing deals, handling the diligence process, the documents, and most importantly, really the follow-up and managing and tracking performance. So law and finance hybrid type of role. And the merchant cash advance industry is something that came on my radar a couple of years ago. Our offices are in a diamond district, and with the advent of lab-grown diamonds, the industry as a whole had started to suffer, and a lot of the entrepreneurs that were in the space, all of the merchants, started to look to other areas to make money. And several of the entrepreneurs I dealt with started to invest in the merchant cash advance industry. And so, you know, to give a more of a high level overview, when you're a small business, there's a few options. The first is, if you look at the slides, friends and family. A lot of startups get their seed capital from friends and family. They have existing relationships. It's informal. And in many cases, the financing can happen very quickly. Tom, do I have the ability to control the slides, or will you just, okay, got it. Secondly, I've dealt a lot with startups, and they find angels, and angel investors are very active, a lot in tech, some in, you know, real estate ventures and otherwise. And I've represented a lot of clients through the years that were angel investors to look at projects. And, you know, if you have something sexy with a lot of growth potential, you can potentially attract this type of capital, but it's not what you normally would get from an existing business, specifically existing businesses that need capital very quickly, because at times it's a longer period for financing. The next example is venture capital, which is from funds in Silicon Valley, funds in places like Chicago and Austin and New York. And it's a longer diligence process. There's more money there. I know many tech startups that raised, you know, $100 million through venture capital funds, and you know, their model is they go into 10 deals and hope to work out, and those 2 yield substantial returns, and it makes up for the ones that don't work out. Nice thing about venture capitalists is also you oftentimes could get one that has some expertise in your field. Okay, next slide. Traditional banks. So, you know, when I'm dealing with larger businesses that have a long operating history, they, like anyone else, could walk into their bank, provide some financials, and normally in a month or 2, they can get a business line of credit or something through the SBA. But you need to have an operating history, and the owner of the business has to have a good credit history, and the business itself has to have a good Dun & Bradstreet report. And there's extensive underwriting, and sometimes these things could take 2 or 3 months. Which leads me to the merchant cash advance industry. It's an industry that's fairly young in terms of the history of finance. I would say it really started to pick up steam 8 or 9 years ago. And it's primarily a mechanism for small businesses. And it's really helpful in two cases. Number one, if you don't have the ability to go to an angel, a venture capitalist, or a traditional bank, or friends and family, or you need capital very, very quickly. The main separator of merchant cash advance businesses versus other types of financing is speed to fund. I have seen deals fund the same day. Some could be done. I've had one done in 90 minutes. And so if you're a business that's otherwise healthy but has an emergency and needs capital very quickly, this is one avenue that you may seek some financing. So the way it works, you're not actually lending money in the merchant cash advance industry. That's much like factoring. What you're doing is you're buying a stream of income, which is the future receivables of the business, and you're buying the future receivables of the business at a discounted rate. For example, let's say a business has $100,000 of receivables. A typical cash advance company would likely buy that $100,000 of receivables for $75,000 or $80,000. And the hope is that over time, that yield will be above what we could typically get in the marketplace. The quicker that those receivables are recovered, the higher your yield. If you buy $100,000 worth of receivables for $75,000 and that loan's paid off, that balance is paid in 1 month, you've effectively made $25,000 of a $75,000 loan. So that's substantial interest. If that loan or that advance, happens to take longer, you have a lower yield. Maybe that $100,000 doesn't come back for 14 months or 9 months, and so your yield's a little lower. And when a file goes through the underwriting process, the underwriters understand the velocity of the revenue for that business in determining how they're going to price that advance. If it's a business that takes longer to generate receivables, then you might pay $50,000 for $100,000 of receivables. If it's something that's more active and has a lot of customers and a lot of velocity, maybe you're paying $90,000 for that $100,000. And that's the underwriting process, and that's the analysis that takes place probably 40, 50 times a day for most major MCA shops. And go to the next slide.
Are you seeing client onboarding?
Okay, yeah. So the clients come through the MCA financing process generally through brokers. In the industry, the terminology is an ISO, an independent sales organization. What is that? It's basically a digital marketing firm. So they're finding leads through pay-per-click, through paid social, through LinkedIn ads, or any other types of digital strategies. Those leads go to these brokerage shops, they qualify the leads, and every MCA firm has certain criteria that they look for. It could be the operating history of the business. Do they have a business checking account? Do they have a lot of customers, or is it more isolated to a few customers? And so the ISO is really screening the potential merchants, and once that they have done that, they'll allocate those or triage them to the types of MCA financing firms that will tender capital. What generally happens is you have some firms that focus on more what we would say A paper, which would be businesses that might need emergency financing but have no debt at all. So they have a completely clean balance sheet from the debt side, but they just need money very quickly. And that's very safe if it has a solid cash flow history, because you see there's customers, you see bank statements, and you know you're going to get paid. Some funders will get maybe what we call B paper, which is maybe there's already an advance or some other SBA loan or some other debt on the business. You're taking a subordinated position. The subordinated position may still be fairly safe once the underwriters have looked at it, but because it's subordinated, just like any other debt, it's going to be higher yield. And you might see yields 20, 25, 30, 35, 40%, where that A paper, where it's a debt-free business taking on its first financing, might be 8 to 12%. So what happens is the merchant gets an offer from an MCA firm. That offer, once accepted, results in a contract digitally signed by a merchant, and there's a verification process to make sure that the bank statements are real. So when the application's submitted, the merchant provides bank statements to the funding group, but you don't know if they're real bank statements. So there's a verification process to make sure they're actually true and correct. So it'll be a Zoom or some other platform like this where the funder will see that you've actually done the revenue per month that you've claimed that you've done. So you have the verification, you have an interview, you exchange wiring or ACH information, and then the funding takes place. What normally happens, if we go back to our $100,000 example, you buy a position for $75,000, you get $100,000. They generally result in daily debits. So that $100,000 may come from a $500 ACH debit every day for 20 days, or excuse me, 200 days. So the merchant who's taking an advance is normally on day 2, 3, or 4 already starting to pay it back. They're paying it back in small numbers, but it's a little bit of a hedge or protection on downside for a funder, because the money's not going completely out and then they're not seeing an interest payment for a month or a quarter or a year. It's actually happening within days. And so we find that that's very effective in the collections process. Tom, you could skip this slide. It's not super important. Yeah, one example just to share is an article I read in the Wall Street Journal where private equity funds, they get commitments, they get capital commitments from their LPs. So they could be pensions or other large institutional investors, insurance companies. And what happens sometimes, or even these large institutional investors don't always have a ton of liquidity, so they sometimes need time to meet their capital calls for these different private equity funds. And what's happened over the years is the funds, if they need to get into a deal very quickly, instead of waiting for their LPs to actually fund, they take short-term loans themselves, which are capital call loans. So this is more bulge bracket, large financial industry stuff, but the rise of very rapid finance overall is a growing industry. Give you some examples. So restaurants, manufacturing, service, these are some typical industries you'll see in the merchant cash advance space. A lot of restaurants. The example I like to give is you have a restaurant, they have daily cash flow, they have customers, and some piece of machinery breaks and they need it the next day or 2 days or 3 days, and maybe they don't have the money in the bank right away to buy it. Maybe they could buy a used piece. Maybe it's cheaper to have the cash versus equipment financing, because in a week they're going to get their payments from their credit card processor, and so they need money same day, next day. I see this a lot. The restaurants are generally really good clients for the merchant cash advance industry because they derive their revenue from a lot of different sources. Think about it, if you're like a general contractor and you're doing 1 or 2 developments and you only have 2, 3 clients paying your bill, well, you have a lot of risk exposure there if any 1 or 2 or 3 of them go bad or are delayed in payments. restaurants are sitting there 50, 100, 200 covers a day. So the revenue is coming in. It might be slower than expected, but at least there's pretty good velocity. In manufacturing, a lot of times it's machinery. Something breaks, something goes bad, or what I've seen a few times is you have a manufacturing process and the raw material suppliers will often provide discounts. Maybe they have excess raw materials they want to move. Maybe they're trying to meet year-end numbers or quarter-end numbers, and they'll provide heavy discounts, or maybe there's shelf life issues or whatever else it is. And so if the capital's available quickly, there could be substantial discounting where your cost of capital may be lower than the amount of discount you're getting from your suppliers. Third example I'd like to give, we have a lot of accountants that will take a merchant cash advance because their work is generally seasonal if you're in a tax prep space. So I've got one gentleman who I think went through 7 rounds where he's a little tight January, February, then he starts to do corporate returns and LLC returns and individual returns, and his revenue once his bills are paid in April, May, and June are very good. So he'll take an advance for 60 days, 90 days, pay it off. So I've seen it a lot with accountants, some other professions, but accountants have been the most active merchants in this space.
Hey, Pete, it's Tom. I'm going to interrupt you because I literally heard a great story today that immediately made me think of this. If any of y'all were watching CNBC today, I was listening on the radio, so I didn't hear who the guy was, but they had a CEO of a shoe company. They sell shoes. And he was saying that there's a load of shoes on its way to the US on a boat from China. And his company had budgeted $46,000 to pay the duty on those shoes coming in. It was a 6% tariff on shoes coming from China. Well, as you probably know from the news, they just added 20% to that. So now the tariff is 26%, and the guy's like, we got to pay $180,000, it's unexpected tariff on these shoes coming in. And he's like, well, they're not telling you about that. And they're not telling you that I got to pay that tariff when the shoes hit the US border. He goes, and then it takes me another 2 months to get them distributed to the distributors, put in the stores, sold, collect the money. I got a front now, 140 grand that is not in my budget. And that's just that one shipment. And so just another example where he knows he's going to make the money back because now he's going to charge, increase the price on the back end, but he's got to get that cash. Now that company may be big enough, it's not a big deal. But if you're a small player, this kind of stuff disrupts you and creates an unexpected need for quick cash. So that's obviously what this industry is targeting.
That's a good example. I want to talk about diversification. It's very, very important. People that don't know much about this industry, and people that do, are always concerned with defaults. And defaults, that's important because if you advance funds and you don't get paid back, you lose. So when the underwriters look at a file, they look at a variety of things. Now, there's an important point I missed. And Tom and I talk about it in more detail when the presentation's done. We're investing as passive investors with underwriting teams, merchant cash advance shops. So what I've done with past deals is I want to be diverse in what I get into. So, I might want a little bit of A paper, a little bit of B paper, A paper a little safer, B paper a little bit higher yield. I want to be in a variety of industries. I don't want to be in one industry that goes bad. Now I guess that the front of the news is tariffs, right? If you're in an industry that's affected by tariffs and that becomes a problem and you have 20 merchant cash advances you're collecting on, and all of a sudden there's supply chain issues or cost issues, and then your merchant can't pay you, that's bad. The next, which is extremely important, is term. There's some of these advances are paid in a week, some of them are paid in 6 months, some are paid in a year, and a lot of it has to do with the flow, the velocity of revenue that a business experiences. So I like to have a mix in term. I might have a 1 week term emergency advance that 1 week term, I feel pretty strongly I'm getting paid back. If you annualize the return on that week, the APR could be outrageous. But it's someone that needs the capital very, very quickly, and it's worth it for them to turn around. And lastly, there's a lot of different underwriters in this industry that use different concepts. Some use AI, some do more pen and paper, but I like to work with a few different underwriters who I get to know and understand their processes, because at the end of the day, we always want to keep the default rates very, very low. The nice thing is the yields are in this industry are strong, so there's room for these groups to default, to have some defaults. You're always going to have some defaults, but if you underwrite well, your default rate is generally very low.
Sorry, I was reaching for the unmute button. And not only do you try to manage for a lower default rate, but when we talk about these higher returns on particular loans, of course, that helps compensate for the default rate that is kind of inevitable.
Correct. And renewals are important because when you have a merchant cash advance fund, there's a lot of upfront costs with respect to the underwriters and the ISOs, the brokers that are bringing in the deals. So because the yields are so high, the brokers get paid a substantial commission. It's not unheard of that you have a merchant cash advance for $100,000. That's a good file. The broker might get $8,000 up front, $10,000 up front, because over time, the merchant cash advance funder might make 30, 40, 50%. So, paying that fee is worthwhile. It's a cost of doing business. But once you've got that merchant in the door, you have the benefit of an existing relationship. And that's important really for two reasons. Number one, you now have familiarity with that merchant. You know the velocity of their revenue. You know if they meet their obligations when there's an ACH debit on their account on a day that they need to pay, and you know that ACH clears and that ACH is cleared week in and week out. You have a much greater comfort level that this person's reliable over time. The other piece of it is you don't have a broker fee anymore. So whereas you might have paid $8,000 for that $100,000 advance and that cut into your yield the first time, that merchant comes back in a month or two or even a year or two, you don't have that commission anymore. So overall, it helps the yields and it helps offset the defaults that might occur with bad files. So this is just a clip of a spreadsheet from a portfolio we were in. So what happens is in the far left column, it's the amount of the cash advance that our capital went into. So and if you go to the top of it, $646.07. The second column was the total amount of the advance to the merchant, and then the third column is a percentage. So in that specific advance, our group had 8.6% of the overall advance to the merchant. And the next column is what was paid out by the merchant in that specific time period. So we know what we have, what the total advance was, the percentage of the total advance that we own, and then we have the monthly cash flow that has come from that specific advance. And then the last column, we have good standings, collections, and sometimes if something's defaulted for a while, there might be outside legal, but a lot of the collections are handled in-house, and it makes the process cheaper because once you go outside, you're having to share a portion of the recovery with the attorney.
Yeah, and I'm going to jump in here again. So what grabbed my attention from a report like this is that Pete's group is, when you think in terms of, hey, we're going to give them money, they're going to loan it out. We're actually taking very small pieces of lots of loans. What that does is you're basically, what's the word, deleveraging your risk, I think is like the inverse of leverage, right? We're going to spread our money again around so many more loans in some cases, $646 at a time in order to reduce our risk of defaults, right? So if that loan defaults, we don't lose $7,495, we only lose $646. So again, when I saw this in Pete's group taking this strategy, I said, you know what? This makes me feel better about, number one, the industry in general, because of course you're going to expect a pretty good default rate, but this is a great way to reduce our risk of that. We may lose a percentage of the portfolio. We're not going to lose the whole portfolio. And then the high returns on the rest of it are going to keep us in good shape, or keep Pete and his firm in good shape, so that we reduce our overall risk. So again, that first column that says $646, Pete's group only provided $646 of a $7,500 loan. And then Pete, I noticed down towards the two-thirds down, there's a couple here where it looks like you guys provided 25% of the total amount. Kind of what is the difference?
Those are more like, I would say, traditional financing. So these are businesses that could have gotten an SBA loan, that could have walked into Bank of America and got a loan. Very safe, debt-free, high velocity sales, just having a cash crunch, emergency issue, whatever it may be. So what we call more A paper. So in those situations, there was a little bit more of a comfort level to lend more. But the median under this last portfolio was 8.6%. So that we're usually below 10.
Got it. Makes sense.
Okay, so this is the transparency part. This is the piece that I liked when we first got involved in this industry. This is a software platform called LendSAS, and LendSAS is effectively the database for a merchant. So if you look up at the top on the left, it has something called the RTR and the advance. The RTR is right to receive. Advance is $15,000. So you have advanced $15,000 to the merchant, and you have the right to receive $22,485. And there's some of the commissions and other things, but ultimately the profit on this specific merchant was $7,185. Now, if you go down to the bottom, you'll see 42, 42, 41. Those are debits. So at the very, very bottom, you see on March 26, 2024, the merchant was debited $299.80. On 3/27, $299.80. So basically every day, some more than once, you'll see a daily debit. If there was a return, which is an ACH pull and there's insufficient funds, or a block, the column that says date returned with return code will tell you that. So that's triggered in the system. So the software will do a daily alert and say, okay, this merchant had a return, and then immediately there'll be someone internally that will reach out to them and say, was it a problem? Did someone bounce a check? Or are you having issues? If someone's having issues, the number one strategy is to extend them out, where this specific merchant's paying $299.80 a day, maybe they should be paying $50 a day. So you want to always make sure you're getting your capital back. If you need a longer period of time to get it back, that's fine. So a lot of these things go through just a couple of phone calls, maybe an email, and they're just basically restructured. And so everything is here in terms of transparency. I can go into any merchant file and know exactly what they're paying on a daily basis, exactly what we make from the specific position. So when I can, at one point I think we were in 400 different positions. All of them are in a database, and I can check the daily progress. So when we started this about a year and a half ago, we originally got into 400 loans, 400 advances, like I said, between 6 and 8%. And our return at the time was around 30%. then we were able to look at every merchant through that platform that I shared with you. This was a straight syndication deal. The only issue was, although the return was 30%, we also had to pay some administrative fees with the underwriters and the like. So we blended a little bit lower, which was closer to 25 to 26. The problem with it was the management. So, myself and other partners, we were constantly having to review possible advances, decide which ones we wanted to get into, pass on the ones we didn't want to get into, see what was collected, see which wasn't collected. And that's all fine if you have $100 million in this, but having $1 million or $2 million, it becomes very administratively burdensome. So what we've done since then, which is working really well, is we've just went to fixed returns, where we will work with an underwriter, we will lend them money at our APR that we agree upon, and then we don't have to deal with the day-to-day of 400 loans. We know they have portfolios, usually 5x to 10x what we've lent to them, and they just pay us fixed interest, and it's a lot cleaner.
Yeah, and then we're able to translate that to the ticker tape investors. Well, first of all, thanks, Pete. I appreciate you coming and explaining all this. I guess this is my part, which is, what is the opportunity for you guys watching the call? So again, going back to kind of how we do deals, ticker tape, we're going to create a new entity, TTI Merchant Holdings LLC. Your opportunity is to buy membership interests in that LLC, and you'll be an owner with an equal vote, one share, one vote, depending upon how many shares you buy, that is how much you put in. And the goal of this endeavor is to return 15% annually on your money, paid quarterly, with a return of your principal in 3 years. The reason for that is that we're going to give the money to Pete, and what Pete is doing is he is managing the deployment of that capital in such a way that he's going to get the principal back in 3 years, which then, of course, he will provide to TTI Merchant, and a TTI Merchant will in turn give you back your money. We really kind of wrapped our head around, the way to do this investment in a way that really gives you sort of bang for your buck is to reinvest your interest, the profit that you make, reinvest that into a growing portfolio. But we had to balance that with sort of the ticker tape philosophy of us not making those decisions for you guys. And so the bottom line is, what we decided to do is we're not going to reinvest your money in an automated way. We're going to distribute every quarter your return, if you will. It'll be, let's just say you put in $100,000, you would get, what is that, $3,750 every quarter. It's a little bit more than that, the way the math works out after fees, but we would send you that distribution. At that time, you could call up Rita or Tom and say, hey, number one, I want to put my $3,750 back into the deal. And there's a little bit of a time lag there, but we would feed it back into additional deals. And so now you'd have $103,750 in the deal. Or you can also add additional capital over time. I know we haven't had a deal like this in quite a while, but in the early days of ticker tape, we had a lot of partners who would literally call up and say, hey, Tom, I'm sending you another 15 grand because I just got my bonus, or I just sold a property, or whatever it is. Go find a use for the capital. So this will be that sort of opportunity. If you want to add to your position over time, it's an opportunity to put the money in and achieve that 15% annual rate, which is tough to get in something that is this risk adjusted, et cetera. What I forgot to put on the slide is that the minimum for this investment opportunity is going to be $50,000, which I know is higher than typical for ticker tape deals, but unfortunately, in order to generate this return and limit the amount of work that Rita and I and our team have to do, managing payments, et cetera, we want to keep that minimum at 50. And frankly, we prefer that each investor put 100,000 or more in to, again, kind of limit the number of individual distributions we have to make. There's no success fee. Typically, we have a annual management fee, administrative fee plus a percentage of the upside. Because of the nature of the deal, there's no sort of equity increase in this deal. So Galago Partners, the company Rita and I manage, is going to subtract 2% per year management fee with a minimum of 3 years. And that is before you get your 15. So the fund is going to generate about 17% a year for each of you, and then net of the 2% management fee, you end up receiving actually 15%. So be very clear about that. The fee there is before your 15% is calculated. So you put in 100 grand, you should get a little bit better than $15,000 per year. Depending upon, do you increase the amount you put in? There is a couple month delay from when we, like Bob may put his 100 grand in tomorrow, and Eric may put in his in 45 days. We'll aggregate that, and it may take a little bit of lag to get it started. But once we fund your portion, you should realize 15% per year, and again, slightly better than that, but approximately 15%. There was something else I was going to say that I've now already forgotten. This is one of those deals where we say this is quasi-liquid, because a year from now, let's say that the group on this call puts in $1 million, we fund it, we start receiving cash. A year from now, this will still be open to new investors. So new people will be able to come in and contribute money to the deal. So if you called me up and said, hey, Tom, I know I'm supposed to get my 100 grand back in 3 years, I'd kind of like to have it now. We're able to shift your ownership to a new investor coming in. Now, depending upon when you call me and who's in the kind of the pipeline of joining, there could be delays in doing that. I know we had one redemption request in TTI debt that literally I got funded back to the original investor within 7 days, because literally before he called me, I had money coming in from a new investor. So maybe you get lucky like that. If we just had a push, brought in a bunch of capital, it's gonna be another 2 months before we have a new investor come in. It could create some delay. That's why it's not liquid. You should not put money in this that you may need for living expenses or operating expenses for your business or anything like that. But there is an opportunity to get out earlier than 3 years if you need to, because we do expect to have accredited investors coming in from time to time. A couple more things before I jump onto the questions. Number one is, if you haven't done so already, reach out to Rita. You should do a personal consultation with TickerTape. We're happy to look at your portfolio, look at your tax situation, look at other things, and point you in the right direction of strategies that we've become familiar with that can help you do everything from save taxes to improve your estate planning to your investment portfolio. How do you find additional categories of investments that you can make? And then last but not least, this QR code gets you connected to all of our social media accounts, where we're putting out, first of all, any deals we have, second of all, any announcements for existing deals, but a ton of educational content. Did one today, what your financial advisor won't tell you. Did one recently, how to invest with the ultra wealthy. We've done 5 mistakes most investors make. We've done tips and tricks for high income professionals. All that sort of above you can get to from our Facebook page, our blog, our LinkedIn, and our YouTube account. With that, I will turn back over to questions. I can see one of them we answered, which is percentages of loans that we take. Another one is, what is the typical duration of an MCA investment? So for us, it's 3 years. I'm not sure if you're asking for this fund or generally in the industry. So I'll answer both. For us, you're putting your money in. The expectation is you can take your money out easily in 3 years. You'll receive distributions quarterly between now and then. And the expectation is that when it matures and we're able to return your cash, you can roll it back in and do it again, or you can add more as we go as well. Pete, I'll ask you, is there kind of an industry standard for that? I'm not familiar with kind of the duration of these type deals.
I would say the average is 90 days.
90 days, okay. Because as I understand it, because I've had partners, clients, and companies I've invested in have taken these advances before. It's sort of like different from a term loan where the borrower knows I've got to pay it back this many monthly payments for a total of 12 months. It's typically either a dollar amount per day or a percentage of the borrower's sales per day. So the term of the repayment is unknown. Is that right?
Correct. Yes. You know, I saw a really weird one where it was an agricultural business, and it was buying a $200,000 or $300,000 advance, and it was structured to last, I think, 60 days. And then the guy had some old receivable that he didn't expect to come in, and the advance was literally paid off in 4 days.
Wow.
I think they gave him a break because it was, you know, it would have been like a 2,000 APR, but they did give the guy a break. But that's not typical.
That's awesome. I see several of these questions we answered. One of them says, what kind of collateral, if any, backs these advances? There's no collateral. They're unsecured, and they're, you know, in the grand scheme of things, each one is a relatively risky loan. They're individually, they're loans that I would not make personally as a standalone lender. The reason that I'm willing to put my capital at risk doing this is, again, we're going to spread this across a bunch of different loans and a bunch of different borrowers in a bunch of different industries with a bunch of different terms. And so by diversifying it that way, we can reduce our risk profile, capture the higher upside, et cetera.
Tom, let me interject for 1 second. There is a UCC1 filed, whereby if you are, let's say you're an online merchant and you're using PayPal or Square, and your payments start to bounce, we do have the ability to capture revenue from the processor. So that has happened on occasion.
I'm glad you corrected me on that. You know, unfortunately, remind me about the AI talking to the AI, but here we have two lawyers talking to each other, so I apologize if this gets too esoteric. But how do you describe that security interest? So I'm going to file my UCC1 and have a security agreement that gives me a security interest in what? Your receivable from
yes.
Priority Payment Systems?
Yes.
Okay, so it's just a specific set of receivables from the borrower's merchant processing provider.
I think they're drafted. The UCC ones are drafted widely enough that it would cover everything. So as long as it's a receivable, so your receivable is coming in through, and for some are easier to work with, some are more difficult. I think, I don't know, Square or Pay, one of them, you know, you provide the loan doc, you provide the UCC, you give them basically the document package. Within 2-3 days, they're diverting the payments to you.
Wow.
So it is effective. Listen, if you have a business that just falls flat, nothing comes in, it's difficult. But most of the time, it's just you know, they're using it for other things. And if you're able to then take that stream of revenue
you're going to get paid very quickly.
Right, gotcha. I was only gonna do one more question, but now I'm gonna do two, because I think these are important points. One question was, what is our default rate in our portfolio? And first I'm gonna say, please understand, guys, that issue is not particularly relevant for this investment at this time, because again, we're getting a flat repayment rate. And the portfolios, the managers, I guess, of the portfolios that we're going to be investing in, they're the ones that are taking that default risk. Having said that, if the portfolio manager did have too high of a default rate that they went out of business, then of course our promised return would, may be in jeopardy. So we do care, but it's not as significant as if we were underwriting our own deals. And Pete, correct me if I'm wrong, I think you said there's kind of like a 7% default rate, but then only about 5% of the loans turn out to be uncollectible. You end up capturing back some spread in between there. Is that about right?
Yeah, I would say on our experience is 7 to 9. But some of those that may seem I'll say uncollectible if that's just a term that I'll use if I don't see the money in a year. That being said, you do have lawsuits, and some pay off in 18 months, some pay off in 24 months. It depends on the jurisdiction and how quickly or slowly a matter goes through the system.
Gotcha. And then last, I wouldn't have taken another one, but this I think it's important. One person is asking, is this a debt or an equity investment? And again, that answer is a little confusing, a little tricky. For you guys, you would be buying equity in an LLC called TTI Merchant Holdings LLC. You'll be a member or shareholder, depending upon whether you want to call it the legal term or the common term of that entity. So you'll technically be an equity owner, but it is indirectly engaging in a debt transaction, right? We're giving money to a set of underwriters / fund managers who are going to deploy that capital as merchant cash advances, but technically we're loaning them the money for 3 years at a fixed interest rate that after fees and paying brokers and all that stuff nets out to 15% to you. But although it is an equity, technically, legally an equity investment, we're not getting an equity return here. We're just looking to get our 15% in what is a very diversified portfolio to reduce the risk. And so we can do better than, the TTI debt fund, looks to bring in 12%. This is a little better return than that, certainly better than what we're getting in any kind of lower risk corporate bonds or anything like that. So that's kind of the goal there. We are longer than I wanted to run, so I'm going to let you guys go and have a good night. Everybody take care. Those of you who are watching this in the future, I'll say hello from the past to you. And on the screen, you should see Rita Carpel's contact info at TickerTape, 832-459-7335. Feel free to reach out to her with any questions. Happy to jump on a one-on-one call with you. And if you want the PPM and are interested in moving forward, she's your gal, reach out to her and she'll send you the package. Thanks, Pete. Thanks everybody for attending. We'll see you guys on the next call.